KO Trade. This is Don Kaufman, May 20th, 2020, a few minutes after the cash close on this Wednesday with the S&Ps, once again, right on the upper cusp, if you will, of that volatility box. But in reality, we're pretty much just north of where we were on Monday. Let's take you into a little bit of detail, specifics of today's trade, which again was a lot more of the same. The FOMC minutes came out, yada, yada, yada. They're going to do anything they possibly can to support this economy. Nevertheless, it didn't really have much, if any, impact to the marketplace. Again, whatever Jerome Powell was saying a few weeks ago during the last FOMC meeting, well, he has said it all before. He was also the star of his own 60 Minutes broadcast this past Sunday. With that, let's, as I said, kind of dig into it. One of the first things, rather than look at this in the spiders and talk a little bit about the volatility box, one of the first things that I want to bring to your attention, and this is critical. The reason it's so critical is if you take a look where we are right now, okay, we are right on the upper cusp of the weekly expected move. That into itself is a very dangerous area to be, because from here, once we start really getting outside the expected move, this is where real hedging activity can kick in and it can just explode from that point forward. As I was saying, not a whole lot has changed, if you will, since we last met on the Monday night video. And to kind of detail that, all you have to do is look at like a 1 day, 1 minute. All we've been doing the last couple of trading sessions, again, is kind of skirting right along the edge of the expected move. And again, more appropriately, what I'm going to do over here is just knock the time frame out. Instead of 1 day, I'll bring up like the last 3 days, knock this to about 5 minutes, hit OK. And what do you got over here? As I said, on Monday, we skirted the upper edge of the expected move. On Tuesday, we skirted the edge of the expected move, sold off a little bit. And here we are on Wednesday, once again, skirting the upper edge of the expected move. And the reason that I wanted to get into a little bit more detail about it, let's talk a bit about the expected move, okay, and the probabilities of this marketplace. So right off the bat, you have to understand the expected move is nothing more. It's just a standard deviation. So you're supposed to be kind of inside this range, that range being right in here. That range is just about $94 this week, right? It's about $94 higher, $94 lower. We laugh, we cry. Listen, the bottom line, there is a much higher probability of us cruising back inside of the expected move. Nevertheless, you have to be aware, even though I say something like, listen, there's a higher probability of coming back in the expected move, that, people, does not necessarily make a trade opportunity. Because what you have to recognize at this point is the fact that we're just outside the expected move. This right here, that's where hedging activity can kick in. And as I said, that hedging activity can rip us higher. Why? Why does that occur? It has to do with trading firms, okay, and negative delta. If a trading firm is negative delta, once we get outside this expected move, how do they actually fight off the negative delta? They add positive deltas. How do you add positive deltas? You come right over here to the S&P futures and you have an algorithm start buying them for you. You got to balance out your equation at all times. So negative delta balanced with positive delta. You do that in the S&P futures, you got yourself a marketplace that can rip to the upside. So even though at this point in time I say that there's a higher probability on Thursday or Friday that we trade back inside the expected move, that doesn't mean that much. Even though there's a higher probability, okay, if there's going to be an up move, it's going to be absolutely violent. Now, that is actually going to be twofold. Not only are we on the upper cusp of the expected move for the week, which unto itself makes this very volatile situation. And, call volatility what you will. And most people are kind of thinking volatility is usually to the downside. But in this case, okay, in this trading week, we've got volatility everywhere. And that can also be to the upside. So as I was saying, the SPX being on the upper cusp of this expected move makes it an explosive situation. To compound that risk, here we are. We are right on the upper bounds, okay, of this volatility box. Now, again, to kind of detail this, and I've talked, okay, excessively about it because, and again, this is exactly what we're doing on the Monday night video. We hopped in here somewhere around the April 8th time frame. We're still in it. We're, again, you're over halfway through May. You're just about 5 on the cusp of 6 weeks inside of a really tight volatility box. And as I said, the longer you're in this vol box, and all we're kind of doing is just channeling back and forth, right? The longer we're in the volatility box, the more dangerous it becomes when we start to crack outside of it. Now, to give you like a really definitive number, again, of where I believe the upper portion of this volatility box happens to be, and again, I like to do that because, to quantify something without giving you anything definitive is nothing. So I'll give you a definitive number, okay? It's right here at 29.83. 29.83, which happens to be one of our gravity points. And the reason I would detail it at 29.83, and again, here we are in the after hours. I mean, come on, people, we're only 11, 12 points off of it. If you get, to the 29.83, if we actually head just north of there, we crack off the gravity point, we fly. And at that point, again, the markets will literally fly. Now, a large portion of me at this point in time, I'm looking at this volatility box. And remember, and I've told people this, I wear my positions right there out in front of you. I am still carrying bearish deltas. And I've hedged off, a lot of those bearish deltas in products like what? Well, the financials. In very large part, the financials. I've got a lot of back ratios in there. I've got some positions right here inside of the EEM, which are also back spreads. It's not going to hedge off all my risk, but if we explode to the upside, it is definitely going to soften the blow. A hedge is never a perfect one-for-one, but in this case, it will definitively soften the blow and soften the blow in a big way. Now, as I was saying, a large part of me kind of believes, in some circumstances, you got to go up to effectively go down. And it's one of the reasons I'm looking at this and I'm thinking to myself, all right, if we're going to do it, bring it. Of course, we're coming into a holiday weekend. When I say you got to go up to go down, that is not, that's my technical opinion. Not at all. What this has to do with is if you look again at most of the professional trading kind of world, the professional trading arena, whether it's prop traders, whether it's hedge funds, they're all saying the exact same thing. Everybody's like, okay, we're just waiting. We're just waiting for it to go down. And that notion alone makes sell side activity difficult because we have everybody positioned really on one side of this. So in large part, I really believe that we have to go up because as we go up, it'll actually cave in a lot of the short sellers. And you got to realize this. Listen, we go up. I'm taking risk as well. When I say it'll cave in the short sellers, one of the reasons that we're going up is because shorts, are going to do what? They're going to buy, to cover. And the more they buy to cover, remember what trading firms have on is negative delta. If you buy to cover, that brings the market higher. If the market goes higher, this trading firm with negative delta has to go out and do what? Add more positive delta. And it starts to fuel, a positive delta kind of spiral to the upside. In large part, we're in this volatility box, but if we crack outside of it, you're going to get, this buying spiral where we're going to rip to the upside and all of a sudden, we just kind of fizzle out and the fuel dries up and we flip back around. Now, I have to also reiterate again, and I hate to have to reiterate what we did on Monday, but it's critical for trade moving forward, right? We have to be mindful that we're not just in some volatility box here in the spiders. That's really short-sighted. Look at the dollar, right? The dollar, all of a sudden, which just, the other day we're like, it's going to crack to the upside. And now it's actually threatening the downside. But it's not just the dollar. The bonds were the exact same thing. We looked at the bonds the other day. We're like, they're going to crack to the upside. And once again, what are we looking at in the bonds now? They're actually ready to breach a little bit lower. Everything right now is moving almost in perfect concert. If the S&Ps are towards the upper edge of the volatility box, the bonds are towards the lower edge of the volatility box. Then we actually have none other than the dollar to the lower edge of the volatility box. People, this is everywhere. Again, be mindful of the level that we provided in here. The S&Ps. Good probability here in the overnight trade. They could tag right into 29.83. At that point, haven't necessarily broken free. But above there, that's where, again, we take the ride to the upside. We literally start squeezing, if you will, to the upside. Again, with all of this going on, it's interesting to see that the bonds today reverted back up. They're up some 25 ticks at this point. Now, this, okay, is the last idea I'm going to give you. Listen, the next 2 days of trade, even though we're coming into a holiday weekend, I don't think it matters. I think we're going to see, again, continued volatility. I'd keep an eye, again, on those bonds. They're coming back to life. Each and every day, we're starting to see just a little bit more volume. You can see the bonds today pumped a little more volume, of course, because they just had the first 20-year, offering bonds. They brought back the 20-year. It's the first time since 1986. Okay, they had the Fed minutes out today. But again, I'm very suspect of the bonds. We're going to be watching them very carefully because if the bonds start rocking, you better believe those S&Ps are going to follow suit. Look for the 29.83 in overnight trade. It is a critical gravity point. Of course, be mindful of the fact that we're sitting right on the edge of the expected move. And again, prepare yourself. There's going to be a lot of volatility this Thursday or Friday. Thanks, everybody, for joining us here at Theo Trade. Have a wonderful evening. Bye-bye.